So what does this all mean? From the 4 different types of crowdfunding, what does it mean for the business and the investor? So if you are a business, we describe 2 different types of businesses. The first type of business is at the idea stage. The second type of business is at the investment stage. Now, if you are a business using a crowdfunding platform, that doesn't mean you're exclusively a startup. However, if you are at this idea stage, then you probably are a startup. And if you are a startup at this stage, then you probably have a concept for a business, you're still working out the details, or wanting to build a prototype. In this case, you should go to a rewards-based platform, which allows you to validate the idea. Because if you are to reach your funding target and people are willing to give you money and you reach that funding target, then the market likes your idea and further validates for you to pursue this idea. And the second benefit is that you're receiving money without having to give away equity in your company. You're keeping all the stock for the business, and now you receive money to further pursue your idea. The second type of business is the investment stage business. At this point, you may be a startup looking for capital, or you could be an established business. You could be a real estate developer, a restaurant owner, or whatever. There's no predefined set of businesses or industries that can use crowdfunding. But if you are at the investment stage, you're probably going to be looking towards an investment crowdfunding platform. Here, you probably know exactly the amount of money you need to grow or execute an idea. And the thing with investment crowdfunding platforms is that the average raised is higher than rewards-based. The average raised on investment crowdfunding platforms is in the hundreds of thousands of dollars. In rewards-based, it's tens of thousands of dollars. And here, if you are a startup, then you need the money to execute an idea. You have all the details worked out. You just need money to execute it. And if you're an established business, then you probably need the money for growth, for expansion, for renovation. We've described 2 different types of investors. The first type is the non-experienced investor. The second type is the experienced investor. What we mean by non-experienced is that you're either non-accredited, meaning you do not own $1 million of net assets, or make $200,000 annually. Or if you are accredited and meet that threshold, you're non-experienced in the angel or just investing in general. And what investment crowdfunding platforms can do for both of these, specifically for non-accredited, what has happened recently is that the Jobs Act was passed in 2012, legalizing that non-accredited investors can invest in business startups via crowdfunding. And what it can do for non-experienced investors that are accredited is to give them this access to be able to get into angel investing. And for both groups, what investment crowdfunding platforms can do, it can offer them the due diligence documents, the valuation, everything they would need to invest in a business startup and give them access to these opportunities they would have never had at low minimums. You can invest as little as $1,000 or $2,000 just to start dabbling into business startups. So what we mean by experienced investor is that you are accredited, meaning you meet that threshold we just described, and are experienced in angel investing, just investing in general. What investment crowdfunding platforms can do is to diversify your systemic risk, your market risk. So that means you can diversify your asset base by investing into multiple startups or just into a different asset class in general. So you're not putting all of your eggs in one basket. And if you are an angel investor, if you are an individual angel investor, it can help increase your deal flow. If you're not having the deal flow that you would like, you can utilize these investment crowdfunding platforms to be able to put extra capital into a different startup to diversify your asset base. And if you are an angel group, you can work with other angel groups to help create a syndicate into a deal that you really like. So investment crowdfunding platforms are just an easy way to streamline all the process and to help diversify and to increase deal flow. In the next couple of videos, we're going to be describing what is the Jobs Act, what is Title III, and the basics you would need to know of how to make an educated investment decision in a business startup.